So today's video is going to be centered around how you can protect yourself from a potential market crash when it comes to your finances and your investments. As I've mentioned in a couple of other videos, right now the economy and the worldwide economy is in somewhat of a precarious spot right now. There are a lot of warning signs that indicate there might be a potential crash within the near future. I just want to make very clear, though, that there are never any guarantees when it comes to finance. If someone ever tells you that something is for sure going to happen, they're probably full of shit. As I mentioned, there's no guarantees. So the economy could keep on going on fine. It could cool down and sort of stay the course. But there is a lot of potential right now that there are sort of warning signs, blinking lights, that are indicating that there is a lot of instability and the markets don't accurately represent what is going on right now. Sort of to put it into an analogy, let's say you are on a plane. If you're beside the pilot in the cockpit, he might be telling you that everything is fine, not to worry, there's a little bit of turbulence, but there's a lot of red blinking lights on the screen right now. There's no guarantee the plane's going to go down, it might be fine, everything might turn out well, but there's enough issues going on that it makes sense to be a little bit worried about what the future might represent, and it's probably a good time to start thinking about how you might protect yourself in the event that there were a crash, and that's the goal of this video, just to sort of explain some ways that you can mitigate the risks of a crash and how you can protect yourself from some of the losses associated with that. And as the whiteboard indicates, diversification is one of the best ways to protect yourself from any market losses or areas of market instability. Now, what exactly is diversification? Well, diversification effectively is the variety in your portfolio, in your investments. What does that mean? It's effectively the difference in type of things that you have. It can be differences in, say, the industries you're invested in. You might have some in technology, some in energy, some in real estate, some in financial. It's the differentiation in types of investments. You might have bonds, equity, gold, and other things like that. And it's also the diversification in the countries themselves. So you might be invested in the United States, Canada, in the European Union, and a couple of different areas. So diversification is effectively how spread out your investments and investment types and investment countries are. Now, why is that important? Well, let's use an analogy. Let's say you have two different farmers. I think I've actually used farming analogies before. It's a common theme, who knows why, but I digress. So, using that example, let's say you have an apple farmer, someone who is exclusively focused on producing apples. Then you have a second farmer who has some wheat, some livestock, and also some apples as well. Now, in this hypothetical example, let's say that something bad happens. There is a new insect that is introduced into the region, and it devastates the fruit trees, all fruit trees. So, the apple farmer who produces all of their income through his apple trees is devastated by this. It has a very adverse effect on his income, and it ruins his farm. Now, the second farmer, who had three different sort of main types of income, one coming from livestock, one coming from the wheat, and one coming from the apples, well, they definitely still are hurt by this event. Well, it definitely still has a negative impact on their life. It does not devastate them. It is a temporary loss, but they can survive through it. The idea behind this analogy has the same effect on the economy and investing with diversification. If you were investing in, say, one specific company or one specific industry, if something is to happen to that industry or company, you will be devastated. It will really hurt you, and especially if they go bankrupt, then you'll likely lose most of your money. If, however, you're diversified, you're spread across a number of different areas. Let's say one of those areas is adversely affected. Let's say it's the housing market. If you only have, say, 5% of your portfolio in real estate, well, that 5% is going to do very poorly, and the rest of the economy might do poorly as well, but because you're so spread out across a number of different areas, all the adverse effects from that are mitigated. They're spread out, and overall your portfolio might go down in value, but you're less likely to be devastated by, say, one specific area of loss. Now, what diversification does really well is it protects your overall portfolio value for the long term. So what happens with diversification, if there is, say, a market crash where the financial and housing sector bottoms out, well, your overall portfolio is going to go down, but because you're spread out across a number of different areas, the individual companies that might go bankrupt, they become small sort of drops in the large pond of your investments. and the value will go down, but eventually when the market returns, you still have a number of investments and they return back in value, and eventually your portfolio goes back to where it was and increases into the future. So diversification is very important to protect your portfolio in the long term. It is a very powerful way to protect yourself. So say you're 30 years old saving for retirement, you have another 30 years before you actually want to retire. Diversification is one of the best ways to protect yourself against these risks of market crashes and other issues with investing. But there's an issue, and that is if you are investing for the short term, let's say that you need the money that you're investing right now in the next 1, 2, 3 years, well, that presents an issue because diversification, while it protects you long term, you can still experience significant losses if the market goes down in value in the meantime. And there are a couple of ways that you can protect yourself in the short term. And one of the first ones is investing in gold. Gold is something that sort of retains its value wherever you are in the world, whether you're in the United States, China, wherever you go, everyone sort of has the same value associated with gold. And because of that, it's a great way to protect yourself against currency fluctuations. So when a country's money's value goes up or down, gold remains pretty steady as value-wise wherever you go. And the second reason that gold is fairly valuable is it retains its value. Price obviously does vary, and it's actually been going down in price recently. It hasn't been doing fantastically, but it is a good way to protect yourself against market sort of issues that happen with equity in other areas. It is traditionally a way to protect yourself against market crashes and losses. Another way is to take your investments out and hold it in cash, but there's an issue with this. So getting back to when I started talking about the video, there are no guarantees with where the market will go. There are a lot of indicators that right now it's not in a great place, but let's say that it does keep on going up. Let's say the crash doesn't happen. If you pull your money out and keep it in cash, you protect yourself against potentially a market crash, but if the market crash doesn't happen, well, then you're out of luck and you've lost out on investment opportunities. So cash is an option, but it also leaves you open to the potential to lose money if the market doesn't actually crash. And a third option, which isn't as great as it used to be, is investing in bonds. So bonds are effectively something where you lend your money to an organization and they pay you a set interest rate over the years that they have that money, and then they give it back to you at the end. But the key thing about bonds is you can actually sell them before the term comes up. So let's say you have a 10-year bond, you can sell it on the 5th year and trade it and sell it to whoever, and then you will get money for it. Now the issue with that is a bond's value changes, because if you have a bond that pays 10% every year, and say interest rates go down to 5%, well, you're not going to sell that bond for that $1,000 that you initially bought it for because interest rates are lower. And because interest rates are lower, you can sell the bond for higher because it has more value. So that's the key with bonds. When interest rates drop, which typically happen after market rate crashes, bonds value goes up. But the issue right now is interest rates are kind of in the dumps right now because after 2008, countries lowered them to sort of kickstart the economy. They're pretty low right now, and bonds are a way to protect yourself against losses. They do provide a modest interest rate right now, typically within the 1 to 3% range, so you can earn a slight return. And as long as you're investing in companies in countries that are fairly safe in the event that there were to happen a crash, they wouldn't go bankrupt, they will offer a modest return while probably and pretty safely protecting your money. So they're typically a better option than cash. They're not as good an option as they were, say, 20 years ago to protect against a crash, but they are okay right now. So just a quick recap. If you are investing for the short term, you're going to need your money within the next, say, 5 years. Gold, bonds, and cash are some ways that you can protect yourself against a potential equity and financial and mortgage sector crash. The thing about that then, just to remember, is if you're investing in cash and if you're investing in bonds and a market crash does not happen, you will not make as much money. So even if you are investing for the short term, it's not a bad idea to have diversification even within that. You might have some cash, you might retain some equity, and you might have some bonds. Having diversification in all aspects is typically a good idea. It protects you. So even if you're investing for the short term, having a spread across those is not a bad way to protect yourself, while also ensuring that you do get some returns in the event a crash doesn't happen. If you're investing for the long term, make sure that you are diversified. across a number of industries, number of countries, and number of investments. That is the best way to protect yourself from specific market events. And just as a last sort of final note, looking at your investments themselves, if you are heavily invested in either the financial industry or the real estate industry, I would highly recommend that you spread that out. I would argue that those are the two most at-risk sectors. Again, a market crash is not guaranteed, but they are by far the sort of, you could say, danger zone right now. Their value is considered the most inflated, and if you are heavily invested with those, I would say that you're playing with fire, and it's up to you whether you want to continue with those, but you are playing with fire if you are heavily invested in either the financial industry or the real estate market. So that concludes this video. Hopefully it helps you protect yourself against a potential market crash. As always, any comments, likes, and please subscribe if you like the content. It helps me create more and keep putting out videos.